Listen carefully because what I'm about to share with you isn't being reported on mainstream financial news. While everyone's distracted by the latest market headlines, something unprecedented is happening in the precious metals market that could determine whether your retirement survives the next 12 months. I've been tracking gold and silver markets for over 2 decades, and I've never seen anything quite like this. The warning signs are everywhere, but most people won't see them until it's too late. Let me walk you through exactly what's happening right now, and more importantly, what you need to understand before the window closes. Right now, as I'm recording this, gold is trading around $2,750 per ounce. Silver's hovering near $31. Those numbers might seem high to some people, but here's what the mainstream media isn't telling you. These prices are artificially suppressed, and the system that's been keeping them down is starting to crack. Let me explain what I mean by that. For decades, the precious metals market has operated on what's called a fractional reserve system. It's similar to how banks work. When you deposit money in a bank, they don't keep all of it in the vault. They lend most of it out, keeping just a fraction on hand. The precious metals market works the same way, except it's even more extreme. The COMEX, which is the major commodities exchange in New York, has been selling paper contracts for gold and silver for years. These are promises to deliver physical metal. But here's the problem. For every ounce of physical gold in their vaults, they've sold somewhere between 100 and 500 paper claims on that same ounce. Think about that for a second. If even a small percentage of people who own these paper contracts actually demand physical delivery, the entire system collapses. And that's exactly what's starting to happen right now. Central banks around the world have been net buyers of gold for 13 consecutive years. But 2023 and 2024 saw something extraordinary. Central banks purchased over 1,000 tons of gold each year. That's the highest level of buying in over 50 years. China alone has been adding between 15 and 30 tons to their reserves every single month, and that's just what they're reporting officially. Many analysts believe the actual numbers are much higher. Why does this matter to you? Because central banks don't buy gold for fun. They buy it because they know something. They understand that the current monetary system is unsustainable, and they're preparing for what comes next. Let me paint you a picture of what's really happening behind the scenes. In March of 2023, we saw the collapse of Silicon Valley Bank, Signature Bank, and First Republic Bank within a matter of weeks. The Federal Reserve had to step in with emergency lending facilities, creating hundreds of billions of dollars out of thin air to prevent a complete banking crisis. Most people have already forgotten about this, but the central banks haven't. They saw how fragile the system really is. Then in October 2023, something remarkable happened. The BRICS nations, Brazil, Russia, India, China, and South Africa, announced they were working on a new currency system that would bypass the US dollar for international trade. They invited Saudi Arabia, the UAE, Egypt, Ethiopia, and Iran to join their alliance. These aren't small players. We're talking about countries that control massive amounts of the world's oil, natural gas, and manufacturing capacity. Now, you might be thinking, what does this have to do with my retirement? Everything. Because the US dollar's status as the world's reserve currency is the only thing that's allowed our government to run trillion-dollar deficits year after year without consequences. When that status erodes, and it is eroding right now, the value of dollar-denominated assets, including your retirement accounts, is at serious risk. Here's where it gets really interesting. In November 2024, something unprecedented happened in the silver market. The COMEX saw the largest physical delivery month in its history. Over 140 million ounces of silver were delivered. To put that in perspective, that's more than the entire annual production of the largest silver mine in the world. Someone, or more likely several large institutions, decided they wanted physical metal instead of paper promises. The same thing is happening in gold. In the first quarter of 2024, gold ETFs saw outflows of over 100 tons. But the price of gold went up during that same period. How is that possible? Because while Western investors were selling their paper gold, Eastern central banks and institutions were buying physical gold at a pace we've never seen before. The paper market and the physical market are starting to disconnect, and when they fully separate, the price discovery mechanism is going to shock a lot of people. Let me tell you a story that illustrates what's coming. In 1971, President Nixon closed the gold window, meaning foreign governments could no longer exchange their dollars for gold at the fixed rate of $35 per ounce. At the time, gold was trading around $40. Within 9 years, by 1980, gold had reached $850 per ounce. That's a 2,000% increase. But here's what most people don't know. The real move happened in the final 18 months. Gold went from $200 in late 1978 to $850 in January 1980. The people who waited to buy gold until everyone was talking about it paid 4 times more than those who positioned themselves early. We're in a similar setup right now, except the fundamentals are actually much worse. In 1980, the U.S. national debt was less than $1 trillion. Today, it's over $36 trillion and growing by $1 trillion every 100 days. In 1980, the Federal Reserve could raise interest rates to 20% to fight inflation. Today, with debt levels this high, raising rates to even 6% nearly broke the banking system. The Fed is trapped, and they know it. Now, I want to address something important here because it relates directly to your financial security. If you're sitting on $100,000 or more in traditional retirement accounts, IRAs, 401ks, you need to understand that you have options most people don't know about. There's a way to move a portion of those funds into physical gold and silver without triggering taxes or penalties. It's called a gold IRA, and I've put together a comprehensive guide that explains exactly how it works. You'll find that link in the description below. It covers the process, the rules, the custodians you can work with, everything you need to know. If you're concerned about protecting your retirement from what's coming, it's worth taking a look at. But let me get back to why this matters right now. Today, not next year or 5 years from now. The system I've been describing, this fractional reserve paper market for precious metals, it only works as long as most people are content holding paper claims instead of demanding physical delivery. The moment that changes, the moment enough people say, "I want the actual metal," the whole structure falls apart. And we're seeing signs that this moment is approaching faster than most people realize. In December 2024, the Shanghai Gold Exchange, which is the world's largest physical gold exchange, saw premiums over London's spot prices reach $40 per ounce. That means buyers in China were willing to pay $40 more than the official price just to get physical gold. That's not normal. That's a sign of shortage in the physical market. The same thing is happening in silver. Industrial users, companies that need silver for solar panels, electronics, medical equipment, they're starting to panic. Silver inventories at the COMEX have dropped by over 30% in the last 2 years. The Silver Institute, which tracks global supply and demand, reported that 2024 saw the 4th consecutive year of physical silver deficits. That means more silver was consumed than was mined. And unlike gold, which is mostly held as a store of value, silver gets used up. Once it's in a solar panel or an electronic device, it's not coming back to the market. Let me give you some specific numbers that should concern you. Global silver mine production peaked in 2016 at about 900 million ounces per year. Since then, it's been declining. In 2024, total mine production was around 830 million ounces. Meanwhile, industrial demand has been growing by 5 to 7% annually, driven primarily by solar panel production and electric vehicle manufacturing. The solar industry alone is projected to consume over 200 million ounces of silver per year by 2025. Do the math. We're mining 830 million ounces, and industrial demand is approaching 1 billion ounces, not even counting investment demand or jewelry. This is why silver is potentially even more explosive than gold. Gold can be recycled relatively easily. Old jewelry gets melted down and comes back to the market. But silver in industrial applications, it's gone. And as the green energy transition accelerates, that demand is only going to increase. Now here's where the retirement angle becomes critical. Most people have their wealth tied up in 3 places: their home, their retirement accounts, and maybe some savings in the bank. Your home's value is tied to the real estate market and the availability of cheap mortgages. Your retirement accounts are tied to the stock and bond markets. Your bank savings are denominated in dollars. Notice the common thread? All of these are paper assets. dependent on the stability of the financial system and the value of the currency. What happens when that system is under stress? We got a preview in 2008. The stock market dropped 50%. Home values crashed. People who were planning to retire had to keep working because their 401ks were cut in half. But here's what most people don't remember. Gold went from $800 in 2008 to $1,900 by 2011. While everything else was collapsing, gold nearly tripled. And the setup today is far more precarious than 2008. Back then, the Fed could cut rates to zero and launch quantitative easing because inflation was low. Today, we're dealing with persistent inflation, which means the Fed's hands are tied. They can't print unlimited money without making inflation worse, but they also can't keep rates high without breaking the government's ability to service its debt. They're stuck between a rock and a hard place. This is why physical metal is different from paper assets. When you own physical gold or silver, you're not dependent on any institution's promise. You're not relying on a bank staying solvent or a government maintaining the value of its currency. You're holding something that has been recognized as money for 5,000 years, something that can't be printed or created out of thin air. Let me tell you about what happened in Cyprus in 2013. The government, facing a banking crisis, decided to confiscate a portion of bank deposits, over $100,000, to bail out the banks. People woke up one morning and found that their savings had been seized. It was called a bail-in, and it set a precedent that has since been written into banking regulations across the Western world. Your bank deposits are now considered unsecured liabilities of the bank. In a crisis, they can be used to recapitalize the institution. But physical gold and silver in your possession? That can't be bailed in. That can't be frozen or confiscated with the click of a mouse. That's why central banks hold it. That's why the wealthy have always held it. It's the ultimate insurance policy. Now I want to address a common objection I hear. But gold and silver don't pay interest or dividends. Why would I hold them instead of stocks or bonds? This is a fundamental misunderstanding of what precious metals are for. You don't hold gold and silver to get rich. You hold them to stay rich, to preserve purchasing power across time and through crises. Think of it this way. In 1920, an ounce of gold could buy you a nice men's suit. Today, an ounce of gold at $2,750 can still buy you a nice men's suit. The purchasing power has been preserved across 100 years. Through the Great Depression, World War II, the inflation of the 1970s, the dot-com crash, the 2008 financial crisis, and the COVID pandemic. Can you say the same about the dollar? In 1920, $20 could buy you that suit. Today, $20 won't even buy you the tie. This is what I mean when I say physical metal is safe. It's not about making a quick profit. It's about ensuring that your wealth survives whatever economic storms are coming. And make no mistake, storms are coming. The U.S. government is currently spending about $6.5 trillion per year while collecting roughly $4.5 trillion in revenue. That's a $2 trillion annual deficit. To finance this deficit, the Treasury has to issue bonds. But who's buying these bonds? Not foreign governments anymore. China has been reducing its holdings of U.S. treasuries for years. Japan, facing its own economic challenges, is no longer the reliable buyer it once was. So who's left? The Federal Reserve, which means printing money, or domestic buyers who demand higher interest rates to compensate for the risk. Higher interest rates mean higher debt service costs for the government. We're already spending over $1 trillion per year just on interest payments. That's more than we spend on defense. As rates stay elevated, that number is going to grow. Eventually, we reach a point where the government has to choose between defaulting on its debt, cutting spending dramatically, or inflating away the debt by printing money. History shows us which option governments always choose: inflation. And this is where gold and silver really shine. They're not just inflation hedges, they're monetary crisis hedges. When confidence in fiat currencies erodes, when people start to question whether their government can maintain the value of its money, precious metals become the safe haven. We're already seeing this play out in other countries. In Turkey, where inflation has been running over 60%, gold ownership has skyrocketed. In Argentina, where the peso has collapsed, people are scrambling to get their hands on dollars or gold. In Lebanon, where the banking system failed and people lost access to their deposits, those who had physical gold were able to preserve their wealth. You might think, That can't happen here. We're America. But that's exactly what people in every country think, right before it happens to them. The British thought the pound would always be the world's reserve currency. It wasn't. The Romans thought their currency was invincible. It wasn't. Every fiat currency in history has eventually failed. The average lifespan of a fiat currency is about 27 years. The US dollar has been a pure fiat currency since 1971. We're now 53 years in, well past the average. I'm not saying the dollar is going to collapse tomorrow, but I am saying that the risks are higher than they've been in generations, and the smart money is already positioning for what comes next. That's why central banks are buying gold at record levels. That's why billionaires like Ray Dalio have been vocal about holding gold. That's why countries like Russia and China have been accumulating precious metals as fast as they can. Here's another angle most people don't consider: the mining supply situation. It takes 10 to 15 years to bring a new gold or silver mine into production, from discovery to first pour. The major mining companies have been underinvesting in exploration for years because low prices made it unprofitable. This means that even if prices rise significantly, we can't just turn on the tap and produce more metal. The supply is relatively fixed in the short to medium term. Meanwhile, demand is accelerating, not just from central banks and investors, but from industrial users. The electronics industry needs silver. The solar industry needs silver. The electric vehicle industry needs silver for batteries and electrical components. As the world transitions to green energy, silver demand is going to explode. And there's no substitute for silver in most of these applications. Its electrical and thermal conductivity properties are unmatched. This supply-demand imbalance is going to resolve itself through price. The only question is when. And based on what I'm seeing in the physical markets right now, the premiums, the delivery delays, the inventory drawdowns, I think we're getting close. Let me share one more historical parallel that I think is particularly relevant. In the late 1990s, silver was trading around $5 per ounce. Warren Buffett, through Berkshire Hathaway, accumulated 130 million ounces of physical silver, about 20% of the world's above-ground supply at the time. Why? Because he recognized that silver was undervalued relative to its industrial demand and limited supply. By 2006, silver had more than doubled. By 2011, it had reached $50 per ounce, a 10x return from where Buffett bought it. Today, we're in a similar setup, except the fundamentals are even more compelling. Silver is trading at a ratio to gold of about 85.1. Historically, that ratio has averaged around 60.1. In the ground, silver and gold are found at a ratio of about 8.1. The current price ratio is completely disconnected from both historical norms and geological reality. This suggests that either gold needs to come down significantly or silver needs to rise dramatically. Given everything else happening in the world, which scenario seems more likely? For retirees and those approaching retirement, this matters enormously. You've spent decades building your nest egg. You've been responsible, saved diligently, maybe maxed out your 401k contributions every year. But all of that wealth is denominated in dollars and invested in paper assets. If we see another 2008-style crisis, or worse, a currency crisis, you could watch decades of savings evaporate. This is why diversification into physical precious metals isn't speculation. It's prudent risk management. Financial advisors used to recommend a 5 to 10% allocation to gold as part of a balanced portfolio. Today, given the risks we're facing, many experts are suggesting 15 to 20% or even higher. Not because they expect gold to go to the moon, but because they recognize that the downside protection it provides is invaluable. Think about it this way. If you have $500,000 in retirement savings and you allocate 20% to physical gold and silver, that's $100,000. If the stock market crashes 50% and gold doubles, your stocks are now worth $200,000 and your metals are worth $200,000. You've broken even instead of losing half your wealth. That's the power of true diversification, holding assets that move inversely to each other. But here's the critical point. You need to own physical metal, not paper proxies. Not gold ETFs, not mining stocks, not futures contracts. Physical metal that you can hold in your hand or store in a secure vault under your control. Because when the system is under stress, when banks are failing and markets are frozen, Paper promises become worthless. Only physical delivery matters. This is what I mean when I say only retirees with physical metal are safe. Not that everyone else is doomed, but that those who have taken the step to own tangible assets, assets that exist outside the banking system, have a level of security that others don't. They've removed a portion of their wealth from the system, from the risks of bank failures, currency devaluation, and market crashes. The window to do this at reasonable prices is closing. As more people wake up to what's happening, as the physical shortage becomes more apparent, premiums are going to explode. We're already seeing it in certain products. American Silver Eagles, which used to trade at a $2 to $3 premium over spot, are now commanding $6 or $8 premiums. That's a sign of tight supply and strong demand. I've been in this market long enough to recognize the pattern. We're in the early stages of what could be a historic move in precious metals, not because of speculation or hype, but because of fundamental supply and demand dynamics, because of monetary policy failures, because of geopolitical realignment, and because of a loss of confidence in the existing financial system. The smart money isn't waiting for confirmation. They're not waiting for gold to hit $3,000 or silver to hit $50 before they act. They're positioning now, while prices are still relatively reasonable, while physical metal is still available without significant delays or premiums. If you're a retiree or approaching retirement, you owe it to yourself to seriously consider this, not as a get-rich-quick scheme, but as a fundamental component of a sound financial strategy in uncertain times. The risks we're facing, the debt levels, the monetary policy constraints, the geopolitical tensions, these aren't going away. If anything, they're accelerating. The question you need to ask yourself is this: if the financial system experiences another crisis, if the dollar loses significant value, if banks face another round of failures, will your retirement be secure? If the answer is anything less than an absolute yes, then you need to take action to protect yourself. And the most proven, time-tested way to do that is through ownership of physical gold and silver. The system failure I'm talking about in the title isn't some apocalyptic scenario. It's the slow-motion failure of a monetary system built on debt and money printing, a system that's reaching its mathematical limits. The failure is already happening. Most people just don't see it yet because it's gradual. But gradual failures can accelerate quickly, and when they do, it's too late to prepare. This is your moment to act while you still can, while physical metal is still available, while the premiums are still reasonable. Don't wait until everyone else figures it out. By then, the opportunity to protect your wealth at today's prices will be gone. The retirees who will be safe are the ones taking action now, the ones who understand that true financial security comes from owning real assets, not paper promises.